Okay, let's go back in time. The year is 1929. We're at the absolute peak of the Roaring Twenties. America is a nation just buzzing with jazz, new cars, and what felt like an endless supply of credit. Everyone, and I mean everyone, believed the party would never, ever end. Well, they were wrong. In just a few terrifying days, the American dream would completely unravel into a financial nightmare. This is the story of what nobody was saying about the 1929 crash. You have to understand, the 1920s were just electric. America was absolutely booming. Factories were churning out goods, cities were growing like crazy, and stocks were climbing to heights nobody thought was even possible. The market wasn't just a game for Wall Street bankers anymore. It had become a national obsession. It was seen as a one-way ticket to Easy Street for everybody. Seriously, with everyone from shopkeepers to taxi drivers playing the market and winning, the optimism was just infectious. The whole system felt completely foolproof. But that leads to the big question, right? The one that was so tragically ignored at the time. What could possibly go wrong? So, how did this massive illusion of permanent prosperity get so big in the first place? Well, it was all built on a pretty shaky foundation of borrowed dreams. It was a market where wild speculation had completely taken the place of any kind of sound strategy. And it all kicked off with one very dangerous idea. Here's the dirty little secret of the Roaring Twenties market, the thing nobody was talking about. By 1929, 2 out of every $3 invested in the stock market were borrowed. Just let that sink in for a second. Most of the market's soaring value wasn't actually real wealth. It was just a mountain of debt, a ton of leverage disguised as success. And the engine that made this whole thing possible was the margin loan. It was dangerously simple, really. You could buy, let's say, $1,000 worth of stock with only $100 of your own cash. You just borrow the other 900 from your broker. And hey, as long as stock prices kept going up, you looked like a genius. But if they fell, the entire house of cards would come crashing down. And don't think this was some fringe belief that only existed on Wall Street. Nope. This came from the very top. President Herbert Hoover himself went on record saying the nation was on the verge of eliminating poverty for good. When you have that kind of widespread confidence, cheered on by politicians and newspapers, it becomes almost impossible to see the incredible risk that's building up right under everyone's feet. By late 1929, though, the cracks were starting to appear. Little things. Steel production slowed down a bit. Car sales dipped. But Wall Street? They just ignored all the warning signs. And this denial would lead directly to 4 of the most infamous and terrifying days in financial history. The collapse was just terrifyingly fast. It all started on Black Thursday, October 24th, with this huge wave of panic selling. The next day, a group of powerful bankers actually stepped in to try and stop the bleeding, restore some confidence. And for a moment, it kind of seemed to work. But the panic came roaring back on Monday. And then, Black Tuesday, October 29th. The floor just completely gave out. The speed at which that fear took over was just staggering. On Black Thursday, a record 12.9 million shares were traded. It was pure panic. But that was just the warm-up act. By Black Tuesday, that number had exploded to 16 million. Fortunes that took lifetimes to build vanished in a matter of minutes. The illusion was shattered. But here's the thing. The story doesn't end with the market crashing. That was really just the opening act. The panic that started on Wall Street quickly spread to the entire economy, and it triggered a chain reaction that would lead to a decade of just unimaginable hardship. And the pain spread to Main Street fast. See, back in 1929, there was no FDIC, no safety net for your savings. So when people got scared and rushed to pull their money out of the banks just started to fail. And when a bank collapsed, people lost everything. Their life savings, their homes, their hopes, all of it just gone. Now, faced with this massive crisis, the Federal Reserve made a catastrophic error. What the system needed was cash, liquidity, to keep it afloat. But instead of injecting money into the system, the Fed did the exact opposite. They tightened credit. They were trying to protect the dollar. But what they really did was turn a financial fire into an economic inferno. And the result of that credit drought was absolutely devastating. With no money to borrow, businesses collapsed, factories shut down, and unemployment, it skyrocketed from just 3% in 1929 to an unbelievable 25% by 1933. 1 in every 4 workers was jobless. The Roaring Twenties had become the Silent 30s. Now, out of all this suffering, some good things did come. the New Deal, major banking reforms, the creation of the SEC. But the story really isn't over. The true lessons of 1929 aren't just about dusty history books. They're about human nature. And those lessons, well, they're still echoing in our markets today. So, after all that, what is the real story here? What's the truth that kind of gets lost in all the historical dates and figures? Well, it's something that goes a lot deeper than just economics. You see, the 1929 crash wasn't an accident. It wasn't just some random bad day. It was the inevitable conclusion to a story that had been written over years. It was a psychological collapse, born from greed, fueled by the incredibly dangerous power of borrowed money, and sustained by this collective, society-wide denial of risk. People simply couldn't imagine the market ever going down. And that is the pattern that still haunts us. That same psychology of this time is different that always comes before a collapse. We've seen it over and over again in the housing bubble of 2008, in the wild mania around meme stocks, in the crazy swings of crypto, and you even hear it in the debates around record levels of national debt. The names and the assets change, but the human behavior, that stays the same. So what can we actually learn from all this? The story of 1929 really leaves us with 5 timeless truths, lessons that are just as critical today as they were almost a century ago, and lessons that, for some reason, we seem to keep on forgetting. Okay, first, when everyone's winning, critical thinking goes right out the window. That herd mentality is incredibly powerful. Second, leverage, or debt, is silent. It makes your gains look huge on the way up, but it makes your losses absolutely catastrophic on the way down. Third, the decisions made by central banks and governments really matter. They can turn a bad situation into a total disaster. Fourth, greed is not an investment strategy. Speculation isn't investing. It's just gambling. And finally, maybe the most important one, history doesn't repeat itself perfectly, but it sure does rhyme. The patterns of human emotion, fear, and greed, they always come back. You know, we often talk about the market like it's some kind of external force, right? Like a casino we can just walk into and out of. But it's not. The market is a mirror, and all it does is reflect our own collective psychology back at us, our hopes, our dreams, and most importantly, our fears. And that brings us to the final thought. The biggest tragedy of 1929 isn't just what happened back then. It's that we keep forgetting the lesson. Humility is probably the best defense against financial ruin, because the very moment we become absolutely certain that a crash can't happen, well, that's the very moment the next one begins.